Hey everybody, welcome to your weekend review for the week of Monday, March 27th, 2023. And oh, what a week it was. Started off the week rough. Why wouldn't we at this point? MBS were down 53 basis points real early. Stocks were up 25 points. Bonds were much weaker overnight with no new news on the banking contagion front. Strong data in Germany and zero usage of the ECB bank swap facility only made matters worse, but the centerpiece of domestic attention was at 2 a.m. Eastern Time announcement that First Citizens Bank would acquire the loans, branches, and deposits of Silicon Valley Bank. First Citizens Bank will acquire nearly $130 billion in deposits and loans. In addition, there were no new drama in the European banking sector overnight. Value works out to roughly an 18% discount on those assets that they bought from Silicon Valley Bank. One of the big things that sunk Silicon Valley Bank was the reporting of its unrealized losses. Barry B pointed out today that the Federal Reserve, has $2.6 trillion in mortgage-backed securities at much lower rates than what Silicon Valley Bank had. Their unrealized loss is currently about $500 billion. So they are now losing money for the first time in history. They're losing about $7 billion a month in interest. Volatility remains highly elevated at more than 2 standard deviations above the trailing 5-year average, with Fed fund futures pointing to the resumption of rate cuts by July. And St. Louis Fed President Bullard is promoting rates by year end to be even higher than they are now. So we got some conflicting things in the market. The average Fed policymakers year end Fed funds target would be at 5.1. Investors foresee 3 cuts by then. I got a feeling the Fed is going to win that one. First Republic is rallying in the morning on news that regulators are considering an additional lending facility. Deposit outflows eased last week as top 25 banks gained about $120 billion in deposits, while 850 smaller banks lost $108 billion. Which I somehow wrote down twice. Sorry about that. Over the weekend, Minneapolis Fed President Neil Kashkari said that the chances of a recession have increased due to the turmoil in the banking session. Then we got a lackluster 2-year auction, but losses weren't as they seem because there was other stuff going on around that time. MBS dropped right at the same time. But the weakness is best classified as incidental because it's only buyers who have dropped their bid prices. Sellers are not chasing the bids at the lower levels, so classic illiquidity issue. Bank health continues to dominate the news cycle with investors buying bonds when things look shaky and selling them. Days go by without new drama. In addition to the ticking clock, reassuring headlines can also take a toll on bonds. That happened overnight as First Citizens Bank assumed that $100 billion plus in deposits and loans from Silicon Valley Bank, although there's no word of what's going to happen to the massive MBS holdings of Silicon Valley Bank. A rally in European equities added to the risk-on sentiment of people putting money into stocks. Domestic hours saw bonds drift sideways to slightly weaker, with MBS losing more than 5/8 of a point and 10-year yields up 16.5 points. So at the end of the day, we were down 47 basis points on the day, which is actually an improvement from where it was in the morning. So ending up at 100.75 puts us in this kind of wide range right where the cursor's at, with a ceiling at 101.155 and a floor down at 100.708. So we'll have to see how the news plays tomorrow.